Good afternoon, everyone, and welcome to the Nedbank Group's 2025 interim results presentation. Our presentation today will start with me providing an overview of the group's performance in the first half, a reflection on the operating environment, and an update on some key strategic developments. I'm then going to hand over to Mfundo, our COO, who will provide an update on the progress we're making on our strategic execution, and Mike, our CFO, will follow with an analysis of the group's financial performance for the period. This includes a pro forma view of the new clusters post the organisational restructure we announced at year-end. I'll then return to close the presentation with an update on the economic outlook and our latest guidance for 2025, as well as for the medium and long term. The operating environment during the first half of the year was volatile and uncertain, as real GDP increased by only 0.1% in the first quarter of the year. As a result, the banking environment was also challenging, given modest South African credit extension, with slow transactional activity as corporates and consumers remained cautious. The difficult environment has a more adverse impact on Nedbank, given our relatively high exposure to South Africa. It remains reassuring, though, that most financial market indicators still reflect cautious optimism. From a strategy execution perspective, the organisational restructure we announced in March has been completed in line with our target date and has now been operationally effective since the 1st of July. Following the strategic review we previously communicated, the group's financial investment in ETI has now been reclassified as a non-current asset held for sale. And I'll provide more color on these initiatives shortly. We delivered a financial performance slightly ahead of our first half guidance of being broadly flat, as diluted HEPS increased by 7%, inclusive of IFRS 5 adjustments related to our share of ETI's second quarter 2025 earnings. Our return on equity, which is usually seasonally lower in the first half of the year, improved slightly to 15.2%. Headline earnings growth of 6% was supported by NIR and associate income growth and lower impairments, partially offset by muted NII growth. Total comprehensive income, a key metric that drives NAV, increased by 26%, reflecting stronger capital generation than earnings growth. Our balance sheet metrics all remained very strong, enabling the declaration of an interim dividend of R10.28, up 6%. Reflecting a bit more on the operating environment, we saw the economy stutter as real South African GDP growth deteriorated quarter on quarter from 0.4% in Q4 2024 to only 0.1% in Q1 2025. Key factors that impacted growth are well known to us all and included slowing global growth, US policy, economic policy and tariff uncertainty, geopolitical conflicts, negative sentiment regarding multiple South African budget delays, and concerns around the stability of the government of national unity. The progress that we were hoping to see on infrastructure investments did not materialize in the first half, despite much effort and activity in the background. To enable foster economic growth, we need to see more progress on structural reforms, which remain too slow. The scorecard that we've shared with the market before, as shown on the left, reflects some positives, particularly a steadier electricity supply, as well as moderate improvements in transport and logistics bottlenecks in the light grey blocks. And here there's still so much more to do. Challenges such as water supply, crime and corruption, struggling municipalities, highlighted in the black box, have deteriorated over the past years and will take longer to resolve. While corporates remain cautious, as reflected in low business confidence levels, we take some comfort from the emergence of the green shoots evident in credit extension, as shown on the right-hand side, albeit behind our forecast coming into this year. On the consumer front, it's encouraging that the environment has become more conducive, given lower rates and inflation, a rise in real disposable income, and as a result, improving consumer finances. So household credit growth, however, is still lagging at 3% and job creation prospects remain limited. So as I reflect on the drivers of Nedbank's first half performance, there have been on balance various positives and negatives. Starting on the left, banking advances growth was modest due to muted demand and slower than expected deal closures. We do remain encouraged by our robust pipelines though. Deal pricing does remain a contested area, particularly for good deals. On the consumer front, we experienced an ongoing decline in unsecured lending market share and pressures on margins primarily from lower interest rates. On the positive side, we gained market share in retail and commercial deposits, home loans and vehicle finance, and showed reasonable client growth. Growth was strong in all our segments across digital metrics, value-added services and payment volumes, while growth in cash withdrawals slowed in line with our payment strategies. Lastly, we have benefited nicely from the Eqstra acquisition that was also not fully in the prior year base. From a productivity perspective, we continue to invest to retain key talent and scarce skills. While expenses were well managed, our cost-income ratio has been under pressure, mostly on the back of slow revenue growth. On the positive side, we continue to benefit from good risk management efforts that supported better impairment outcomes, leading to our credit loss ratio at 81 basis points, moving back to squarely within our target range. Other highlights included branch sales and digital transaction values that increased 11% and 16% year on year. On the cost side, the group's IT amortization charge was lower than the prior year as benefits were realized from our technology investments. We'll continue to prioritize our technology investments as a key strategic enabler in a fast-evolving digital landscape. In line with our efficiency programs, we see a continued decline in the number of employees and a reduction in both office and branch floor space. On the far right, key risk and capital management metrics reflect a very strong balance sheet, as our CET1 ratio sits at 13.1%, well above our board target range of 11 to 12%, and liquidity metrics all significantly exceeded the minimum regulatory requirements of 100%. We partially executed against our share buyback program by repurchasing 500 million rands of equity in the first half, and this was in addition to buybacks earmarked for our LTI program of around 800 million rand. Moving on to the key strategic updates I want to share with you today. In the first quarter of the year, we initiated a strategic reorganization as a catalyst to enhance our focus on clients, drive faster revenue growth, and unlock efficiency and productivity enhancements. So I'm pleased to report that the organisational restructure of our retail and business bank and Nedbank Wealth clusters has been completed on time. This was an important strategic move, embraced by our colleagues and well received by clients and shareholders. We're very excited about the impact of these changes on our future performance. So from the 1st of July, personal and private banking, a cluster solely focused on individual clients, will be led by Tico Thomas. Key changes included the integration of our insurance and wealth management businesses into the new cluster, along with consumer banking and our private banking businesses. Business and commercial banking, a juristic-focused cluster which covers the spectrum of mid-corp, commercial and SME clients, will be led by Andiswa Bata, who has an excellent track record and significant experience in this market segment. We've received the required regulatory approvals, and Andiswa will join us on the 18th of August. The group's asset management businesses now reporting to CIB under Anel Bosman. In the new organisational design, our CIB business will focus on accelerating growth by leveraging its sector-led expertise to unlock cross-sell opportunities and enhance returns. On a pro forma basis, CIB achieved an ROE north of 20% and generates around 8 billion rand of headline earnings on an annual basis, which now includes the asset management business. In the new BCB cluster, where we focus on juristic clients below large corporates, our objective is to accelerate growth through compelling propositions and sector-focused solutions. BCB, along with CIB, are both high-return businesses, and they're well-positioned for growth. Personal and private bank, which focuses on individual clients, from youth entry level all the way to high net worth, will benefit from growing insurance and unlocking cross and upsell opportunities to the 7.9 million Nedbank client base. It'll seek scale benefits as it grows revenues faster and unlocks further efficiencies and productivity enhancements to lower its cost-income ratio. And this is important as we seek to improve its ROE from 14% to above 20%. In our Nedbank African Regions business, excluding ETI, where we focus on all client segments across the 5 SADC countries we operate in, we look to strengthen and scale our franchises and seek complementary M&A acquisitions over time where appropriate. I'm also pleased to report to shareholders that we have concluded the strategic review of our financial investment in ETI. This review considered progress against our initial investment case, which did not materialize as expected. This was primarily as a result of the deterioration of the Nigerian economy in which ETI operates, the exit of various South African clients from that region, limited cross-sell opportunities, and synergies between Nedbank and Ecobank that have not been forthcoming. A minority stake also limited our ability to drive strategic progress, so value realization has been disappointing. Since inception, we've earned 6.8 billion rand in associate income, but only received 400 million rand in dividends. Unrealized FCTR and OCI losses of 6.9 billion rand on the back of weakening currencies reduced our reserves over time and negatively impacted NAV and NAV per share metrics. On the regulatory side, banks in Nigeria face ongoing recapitalization requirements, and as a result, a realistic scenario exists whereby Nedbank may need to inject capital into ETI to prevent a dilution in our shareholding. In that scenario, the investment would most likely have changed from an associate to a fair value investment, which would have introduced significant mark-to-market volatility to our P&L and our returns profile. So our focus now is on preserving the residual value we hold in ETI. This change represents a reset of our strategy on the rest of the continent, with a clear focus on the SADC and East Africa regions in businesses we own and control in areas where we can play to our strengths. As a result, Nedbank's financial investment in ETI from the 30th of June will be classified as a non-current asset held for sale, and we will no longer account for earnings from ETI in associate income, but rather in non-core earnings. And Mike will unpack the financial implications later in his section. The board has approved a formal plan to dispose of the investment, and we are currently engaging interested parties. We expect to execute a clean sale without material suspensive conditions, barring being subject to normal regulatory approvals. Proceeds will be used for other growth opportunities, such as bolt-on acquisitions to enhance scale in our retail and SADC businesses or expansion into East Africa. With that, let me hand over to Mfundo to talk to our strategic execution progress in more detail. Thank you.
Thank you, Jason, and good afternoon, everyone. In my section today, I will provide an update on the progress we have made on our strategic value unlocks in the first half of the year. Starting with digital leadership as the first key focus area. We continue to benefit from investments in technology and our digital capabilities. As we have noted in prior periods, digital onboarding is seamless for both individual and juristic clients. Most of our services have been automated and digitized, enabling our clients to self-service. In the first half of the year, digital activity and usage continued to increase by double digits, as shown in the first 4 graphs. A growing number of clients use our digital platforms, in particular our apps, as evident in the 10% increase in Money app users. We also continue to sell more products digitally, and at the end of June, 70% of all retail sales were on digital channels. Our juristic businesses also noted steady progress as the adoption rate of the Nedbank Business Hub increased to 65% from 56% in the prior year. While our Managed Evolution Technology Program concluded at the end of last year, new technologies have emerged over time that are very attractive to us. We will continue to invest in technology solutions in order to maintain the resilience of our operations, to progress our digital capabilities, particularly our card systems, and to focus on payments modernization. In a market that has not been conducive for growth, we continue to service our clients well with great value propositions. This was demonstrated by being ranked number 1 in Net Promoter Score among the large South African retail banks. Our small business services business segment recorded their second highest levels of NPS in 9 years. And CIB achieving a client satisfaction score of 80% in line with global benchmark. An example of how we delivered market-leading client experiences in the first half of the year was bringing South Africa's first fully online iPhone trade-in solution to life via our Avo platform, as shown in the bottom of the slide. This is now being extended to Android devices. Our new dedicated mid-corporate service model, launched during 2024, has also been well received, with the latest customer satisfaction study concluded by KPI Research showing Nedbank achieving the highest score in NPS when compared to its peer group. A key highlight of the period was the Nedbank brand value that increased by 24% to 20 billion rand and now ranks number 8 among all South African companies. In Nedbank Africa regions, we led in brand sentiment scores in Eswatini, Lesotho, Mozambique, and Zimbabwe. As part of strategy execution under strategic portfolio tilt, we increased market share across home loans, vehicle finance, retail deposits, and commercial deposits since December 2024, as highlighted by the green arrows, but still fall short of our desired portfolio mix ambitions. In commercial mortgages, where we have a leading market position, we supported our clients and our market share remained strong around 36%. Wholesale term loans recorded a small decline as competition for scarce and good quality assets remains fierce. Market share losses for both personal loans and credit card have slowed, and with appropriate risk management, we would expect our performance in these unsecured categories to improve over the next 12 months. Going forward, we aim to gain further deposit market share with a heightened focus on transactional deposits and to scale our retail lending products, as well as leverage our strengths in CIB, including energy, infrastructure, mining and resources, and commercial mortgages. In our retail consumer business, main bank clients showed reasonable growth and cross-sell remained steady at an average of 2 products per client. In the affluent banking segment, our market share was fairly stable at 14%, and we were pleased to have retained our second position in the SME segment with a 24% market share at a time of growing competition. As part of our 2024 results, we shared various new transformational growth initiatives that leverage the group's strong foundations and areas of expertise to help us unlock new revenue and cost optimization. These growth vectors include, amongst others, leveraging the investments we have made in IT, unlocking faster growth and cross-sell in insurance products into the Nedbank client base, payments modernization, portfolio diversification, including expansion into East Africa by using our expertise and capabilities in CIB, as well as the launch of a dedicated new offering to transform how mid-sized corporates access financial solutions through our business and commercial banking unit. Today, I will not talk to all of them, but focus on the progress we have made on payments and insurance. With regard to payments modernization, we recognize the large potential of digitizing small, faster payments instead of using cash, which has become very expensive to manage. Our participation in industry modernization initiatives and our own payments efforts enabled us to create a fully interoperable enterprise payment service hub that optimizes the cost to serve, increases innovation frequency, responds to open finance opportunities, and unlocks competitive advantages of embedded payments in real time. Being first to market with Apple Pay, PayShop, and payment APIs highlights our thought leadership and agility. These innovations and our pricing strategy that positions Nedbank among the market leaders on PayShop have resulted in strong growth across payments categories. In the first half of 2025, we recorded more than 250% growth in PayShop volumes and very strong growth in contactless payments, value-added services revenues, e-commerce, and money app payments, compared to only 2% growth in ATM cash withdrawal volumes. With regards to insurance, the opportunity still is to grow and cross-sell traditional bancassurance and new solutions, such as MyCover Suite, into the Nedbank client base. This approach aims to increase client penetration from about 19% to more than 30% as we grow gross earned premiums by more than 50% in the medium term, enabled by strategic reorganization of insurance into the personal and private banking business. In H1 of 2025, we made good progress with the integration of the credit life cover into digital client journeys, greater rollout of personalized client offers, and enhanced product, channel, and service enablement. Gross earned premiums in the MyCover funeral, personal lines, and life product lines increased strongly, as shown on the right-hand side, reflecting greater engagement and adoption of Nedbank's digital insurance solutions. Credit life penetration in card and overdrafts increased significantly due to API integration, as well as pre-approved and targeted offers, while ongoing initiatives are expected to further enhance insurance penetration in home loans and vehicle finance. And our fifth and final strategic value unlock, we continue to provide loans and finance to clients that are aligned to the UN Sustainable Development Goals. At the end of June, we had sustainable development finance exposures of around 189 billion rand, representing almost 20% of the group's total gross loans and advances, the ambition we had set for the end of 2025. During the period, we saw strong ongoing growth in renewable energy and infrastructure. On the right-hand side of this slide, we illustrate the work we do under sustainable development finance in more detail and how our leadership in commercial property is entrenched through various sustainability initiatives, such as the conclusion of a $200 million IFC facility for development of green certified residential and commercial buildings, the launch of the South African Real Estate Investment Trust Sustainability Disclosure Guide, and the development of a building efficiency scale to help clients assess their buildings on sustainability metrics. We also continued our leadership in renewable energy, evident in 47 billion rand of loans exposures relating to clean energy, with limits having increased by 19% to 67 billion rand, highlighting the robust deal pipelines in place. I now hand over to Mike to take us through a review of the group's financial performance.
Thank you, Mfundu, and good afternoon. Our financial performance for the 6 months to June was slightly ahead of guidance and in line with our own expectations when excluding the impact of IFRS 5 adjustments. This is reflected in headline earnings growth of 6%, DHEPS growth of 7%, and an ROE that improved slightly to 15.2%. Basic earnings per share, however, decreased by 8% as a result of an impairment loss relating to the accounting of our share of ETI's Q2 unrealized FX gains. On the back of slow revenue growth, our cost-to-income ratio increased to 57.4%. Our credit loss ratio decreased by 23 basis points to 81 basis points, pleasingly now around the midpoint of the group's through-the-cycle target range. Gross banking advances growth was modest at 6%, while deposit balances increased by 10%. Our key balance sheet metrics remained very strong, evident in the capital and liquidity ratios. The key drivers of shareholder value creation were positive, with our ROE, which is seasonally low in the first half of the year, above cost of equity. On the back of our strong capital and liquidity position, we declared an interim dividend of R10.28 per share that increased by 6% at the top end of our payout ratio. Net asset value per share of just over R245 increased by 6% year on year, supported by very strong comprehensive income growth of 26%. Unpacking the numbers, headline earnings was up 6%, and as shown in the bright green bars, the key drivers were non-interest revenue and associate income that increased by 6% and 83% respectively, and an 18% reduction in impairments. Net interest income increased by just 2%, in line with our low single-digit pre-close guidance. Expenses increased by 9%, slightly ahead of guidance. Reflecting on the balance sheet, as shown on the right-hand side of this slide, gross actual and average banking advances grew by 6%. CIB gross banking advances increased by 8%, as term loans, reflecting largely the growth in our investment banking business, grew by 12%. Positively, this growth was driven across various sectors, while pipelines into the future remain robust, although taking longer to convert. Book growth in property finance benefited from the positive momentum carried over from the prior period, although growth slowed late into half one. RBB gross banking advances increased by 5%, primarily driven by gradual home loans and vehicle finance market share gains, reflected in 5% and 9% growth respectively. Dispersals in unsecured lending continued to be subdued, as we deliberately followed a more cautious approach in extending credit given elevated risk. Growth in commercial banking decreased as clients adopted more prudent borrowing behavior in a difficult environment. On the opposite side of the balance sheet, deposits increased by 10%, driven by transactional cash management balances that grew 36% and call and term deposits that grew 12% as clients extended tenure, leveraging Nedbank's competitive term offerings. Other deposits rose by 8%, due to an increase in step rate deposits and structured notes, while fixed deposits increased by 5%, driven by competitive pricing strategies in key investment products. In contrast, NCDs and current accounts and savings accounts both increased by just 1%. Turning to the income statement, NII increased by just 2%, as growth in average interest earning banking assets of 9% was offset by contraction in the margin. The 9% growth was driven by 6% growth in average banking advances, as well as higher levels of high-quality liquid assets. The 26 basis point decline in net interest margin to 387 basis points was primarily driven by a 10 basis point negative endowment mix impact, due to net capital and transactional and savings balances growing slower than average interest-earning banking assets, a 10 basis point negative endowment impact from lower interest rates, asset and liability pricing pressures, given increased levels of competition for good quality balance sheet, as well as asset mix changes as low margin assets grew faster than high margin assets. Non-interest revenue growth was 6%, in line with the guidance we provided during the group's pre-close update of above mid-single digits. Commission and fees increased by 11%, supported by the acquisition of Eqstra that was not fully in the prior year base, and continued strong growth in maintenance fees and value-added services. We were particularly pleased with transactional non-interest revenue growth of 9% in our consumer banking business, reflecting good traction in strengthening the franchise. Growth was partially offset by CRB deal flow that was delayed into the second half, as well as reduced cash volumes in RBB. Trading and fair value income decreased by a combined 12%, including a 2% decline in markets and lower levels of fair value relating to our macro fair value hedge accounting solution in the centre. Trading income in CRB increased by 5%, driven by strong forex growth offset by weaker equity trading income. Fair value income in CRB declined due to the non-repeat of strong 2024 valuations across CRB. Insurance income declined by 6% due to lower NIR from personal loans credit life policies as a result of stricter lending practices that led to a reduced personal loans policy base and sizable positive actuarial basis changes in the prior year. This decline was partially offset by an improved non-life claims experience and strong growth in premiums and policies within the MyCover suite, as Mfundo highlighted earlier. Lastly, other non-interest revenue included strong equity investment income growth of 27%. Turning to impairments, the group's impairment charge decreased by 18% and credit loss ratio reduced to 81 basis points from the 104 basis points reported in the prior period, driven primarily by an improving macroeconomic environment, the ongoing benefit of decisive management actions over the past 2 years with regard to loan origination and collections efforts, and lower levels of Stage 2 and Stage 3 loans. The CRB credit loss ratio at negative 15 basis points benefited from the resolution of 2 large clients in default and was below its through-the-cycle target range. Stage 3 loans in CRB declined by more than 2 billion rand year on year. RBB's credit loss ratio decreased to 168 basis points from 183 basis points in the prior year, now below its through-the-cycle upper limit of 175 basis points. Home loans and Nedbank Commercial Banking reported improvements in their credit loss ratios, while motor vehicle finance and personal loans credit loss ratios remain elevated. Nedbank Wealth reported a credit loss ratio of just 2 basis points below its through-the-cycle target range due to credit model enhancements implemented in the second half of last year and higher Stage 1 asset quality in the Nedbank Private Wealth South African portfolio. NAR reported a credit loss ratio of 154 basis points above its through-the-cycle target range of 85 to 120 basis points, driven largely by expected credit loss model reviews in Mozambique, given political unrest and instability in that country, higher impairments in Namibia on the retail home loans portfolio, as well as adequacy updates in Eswatini. Within gross loans and advances, Stage 1 loans increased by 10%, while Stage 2 and Stage 3 loans reduced substantially. The group's total ECL coverage at 3.2% decreased from the 3.51%, mainly as a result of the decrease in Stage 3 loans, and remains strong and reflects prudent provisioning. The Stage 1 coverage reduced slightly, while Stage 2 coverage remained flat, and Stage 3 coverage increased to 39.5% as RBB loans with higher coverage remained broadly flat, and Stage 3 loans in CRB declined since June last year. Shifting our focus to costs, expenses increased by 9%. However, underlying expenses excluding Eqstra increased by just 6%. A 9% increase in salaries, wages, and employee costs reflect the impacts of an average annual salary increase of 6% and the additional investments to retain talent and scarce skills. Incentives increased by 1%, aligned with profitability metrics and vesting probabilities relating to corporate performance targets. Computer processing costs increased by 5%, driven by continued IT investment and higher digital volumes, partially offset by negative growth in the amortization of intangible assets. Communication and travel costs increased by 43%, and fees and insurance costs increased by 12%. Marketing costs were well contained and increased by only 1%, while occupation and accommodation costs decreased due to the ongoing benefits of real estate optimization initiatives. Turning to our ETI associate investment, associate income increased by 94%, driven by higher than expected earnings from ETI of 705 million rand and an additional quarterly catch-up of 281 million rand of ETI's quarter 2 earnings that would typically be included in Nedbank's third quarter results, as we have now moved the investment from an associate to a non-current asset held for sale under IFRS 5 as of the 30th of June, having now completed our strategic review. The graph on the right unpacks the movements in the ETI carrying value over time. Of note is the 6.8 billion rand of associate income that was accounted for since inception, while our share of foreign currency translation reserves and other comprehensive income losses of 6.9 billion rand were also accounted for on balance sheet since inception. From 1 July, ETI will now be accounted for at fair value, with no further earnings accounted for through the associate income line, and this will negatively impact on ROE from the second half. Moving to capital, the movement in our CET1 ratio from December reflects solid capital generation, the payment of the group's final 2024 dividend, a 4% increase in risk-weighted assets from December, and a small impact relating to share buybacks during the period. The increase in risk-weighted assets was driven by 3% growth in credit RWA and 32% in market risk as a result of increased market volatility following the US tariff announcements. Our CET1 ratio at 13.1% remains well above the top end of the board-approved target range of 11 to 12%, positioning us well for growth, complementary bolt-on acquisitions like Eqstra, sustainable dividend payments at attractive payout ratios, further buybacks, and to absorb the final Basel III reforms. Closing with the financial performance of our clusters, and I will for the last time report on the clusters in this construct, given our organisational restructure covered by Jason earlier. CIB produced headline earnings growth of 3% and its ROE increased slightly to 20.9%. Earnings growth was supported by lower impairments and disciplined capital management. NII decreased by 4%, reflecting average gross banking advances growth of 7% and a decline in the net interest margin on the back of lower interest rates, competitive pricing, and a shift to lower risk sectors. NIR decreased by 5% due to lower commission and fee income and a 2% decline in markets revenue. This was partially offset by equity investment income that increased by 18%. Expense growth of 3% reflected disciplined cost management. Headline earnings in RBB increased slightly, delivering a lower ROE of 13.8%. Growth was driven by a 14% increase in NIR, driven mainly by strong growth in commission and fees, supported by the Eqstra acquisition, and a 4% decline in impairments as consumers adjusted to an improved macroeconomic environment and due to the benefit of our ongoing credit risk and collections initiatives. NII, however, remained flat off the back of 5% growth in banking advances and a decrease in margins, mainly due to lower endowment given lower interest rates. Expenses increased by 10%, but only 4% when excluding the Eqstra acquisition. Headline earnings in Nedbank Wealth was positively impacted by an improved non-life claims experience, strong growth in premiums and policies within the MyCover suite, higher local deposit balances, and good growth in assets under management. Lower impairment balances also contributed to higher earnings. This was, however, offset by sizable positive actuarial basis changes in the prior year and reduced margins in the international business. Lastly, in the Nedbank Africa regions, headline earnings increased by 63%, delivering a strong ROE of 28.6% when including ETI. Headline earnings in our SADC operations, however, decreased by 5%, and ROE remains low at 6.7%, largely driven by higher impairments in certain countries. In closing, the following slide shows the contribution of our clusters post the organisational restructure on a pro forma basis. CIB and BCB deliver 20% plus ROEs, while in PPB and NAR, excluding ETI, ROEs remain low and are below our cost of equity at 12% and 7% respectively. CIB remains the largest contributor to group earnings, deposits and lending, all above 45%, while BCB is a strong funder of the group at 20%, while earnings contribution and advances are lower at around 16 and 10% respectively. PPB contributes 26% to earnings, a healthy 30% to deposits, and 42% to banking advances. Our SADC operations are small at around 3 to 4%, representing an opportunity to grow and diversify, also into East Africa over the longer term. Thank you. I'll now hand back to Jason.
Well, thanks very much, Mike and Mfundo. In closing, I'll provide our outlook for the period ahead, starting with our latest economic forecasts, which informs our updated financial guidance. We still expect banking conditions to improve moderately in the second half, but the 30% tariffs on South African exports to the US, weaker global growth, and sluggish commodity prices will probably continue to undermine business confidence. We now forecast South Africa's GDP to increase by only 1% in 2025, down from our 1.4% forecast in February, improving to 1.6% by 2027. While we factored in the potential negative impact of US tariffs on South African exports, these are difficult to quantify and there's probably downside risk to our forecasts. Inflation should average around 3.4% in 2025 and then gradually rise while remaining around the middle of the SARB target range thereafter. After a cumulative 125 basis points cut in interest rates, including the 25 basis points in July, we expect the prime rate to remain stable around 10.5% for the next few years. Credit extension is forecast to be around 5.6% by the end of the year, supported by a recovery in the domestic economy and lower interest rates. The risk to the credit growth outlook, however, remains tilted to the downside, particularly over the short term. Although difficult to forecast, the rand is expected to average around 18 rand to the dollar for the rest of the year. While the forecasts of economists are more measured, financial markets continue to reflect cautious optimism, and this is evident in lower bond yields, a stabilization in foreign bond sales, stronger equity markets, a stronger rand, and an improved credit default spread back to investment grade levels. Turning to our guidance for 2025, which has been updated to reflect the negative impacts of the operating environment on revenue growth and the change in our strategy regarding ETI. Of course, our guidance in March was predicated on a strong and improving economy in the second half, which now appears rich. NII growth is now expected to grow by low to mid-single digits, driven by a slightly stronger advances growth in the second half of the year, while our NIM is expected to continue to contract further due to wholesale assets growing faster than retail assets and lower endowment income. After a good first half performance, our credit loss ratio is expected to improve further, to be slightly better than the midpoint of our through-the-cycle target range of 60 to 100 basis points. NIR growth is expected to grow at mid-single digits, lower than our initial expectation of upper single digits. Expenses are expected to grow above mid-single digits, revised down from mid to upper single digits as we maintain our focus on managing costs in a difficult environment. As noted earlier, associate income from ETI will not recur in half 225 or beyond. Capital ratios should remain above board ranges and our dividend, subject to board approval, at the top end of the payout ratio of around 57%. We will continue to look for active capital management opportunities through further share buybacks and potential M&A activities. DHEPS, as a result, is expected to grow by low single digits in 2025, revised down from more than mid-single digits, while we aim to achieve an ROE of 15%. In the medium term, our ambition remains to progress our ROE to 17%, with our cost-income ratio declining closer to 54%. We have various initiatives to unlock opportunities in the medium to long term, including benefits from the organisational restructure, various growth vectors around revenue opportunities, M&A activity, as well as further capital optimization. In the long term, we remain focused to increase our ROE to above 18% and improving our cost-income ratio to below 50%. In conclusion, to deliver on our targets, we need focused execution and a pivot for the future. Under focused execution, we will continue to deliver on our perform agenda, including managing through the volatile, uncertain, and difficult operating environment, executing robust lending pipelines, leveraging green shoots in key market share categories, robust payments and insurance strategies, while delivering financial and strategic outcomes that create value. We'll also maintain strong risk management practices and sound capital and coverage levels while remaining good stewards of capital. Pivoting for the future requires us to unlock value from the strategic reorganization, and to provide credibility, we'll finalize cluster key performance indicators and targets and communicate them to stakeholders at the end of the year. Under our transform agenda, we will accelerate efforts to execute on our growth initiatives and seek selective M&A opportunities to drive scale and diversification, including SADC and East Africa. And lastly, we aim to put the ETI investment behind us as we finalize and execute on the sale of that investment in the near term and redeploy capital into our transform agenda. Well, thanks very much, and we'll now proceed to Q&A.